I'm John Belizaire, CEO of Soluna, and today we're in Toronto spending time with our new friends from Node Blockchain. Node Blockchain is the author of an amazing paper called The Positive Externalities of Bitcoin, which takes a positive view on the energy consumption of the largest cryptocurrency network in the world. And today we're going to be talking about the genesis of that paper and the fact that it relates directly to the Soluna project. And these guys are fantastic, so let's get to it. So I'm here today with Saad and Bobby. Hey guys, how you doing?
How are you doing?
Why don't you introduce yourselves and we'll jump right in.
Sure. So my name is Saad Imran. I'm the co-founder of Node Blockchain and the head of research.
And I'm Bobby Ahluwalia, co-founder of Node Blockchain, and I do a little bit of everything.
Why don't you guys start by all right, cool. Jack of all trades, just like any startup. Yeah. So why don't you start by telling us a bit about how you guys came to Node Blockchain, perhaps what you did before this, and then how you found each other and formed this research company.
Sure. Why don't you give
or maybe
your background?
What's Node Blockchain?
I guess I'll start with my background.
Yeah.
Prior to Node Blockchain, I was at Deloitte for 4 years. I was working in the technology advisory space, working as a financial advisor to tech companies here in Toronto and private companies, working with them from seed stage all the way to either US sale, which was the majority of case for Canadian companies here, but also IPO. And, I was always interested in the emerging technology space at Deloitte, and my focus was always to go out there and figure out what the new startups were doing, what they were working on, and what the new trend was, and come back to the partners and help them understand what that technology was. And last year it was all about blockchain, right? And, there's a few companies that were actually co-founded by former Deloitte employees here in Toronto as well. And, the partners were curious. They were trying to understand, where this was all headed, how Deloitte could play a space in this as well. And, ultimately, when I started researching it, that's when I couldn't stop thinking about it, right? And I'm sure
I've heard that from everybody.
From everyone that speaks about it, right?
Yeah, it's so funny. So prior to being in the blockchain space, I was in the insurance space, and I was always intrigued by how people got into the insurance industry. And it was almost never the case that they deliberately did it.
Yeah.
And every now and then I would find it. And now being in the blockchain industry, just about everybody I talk to, the first question I ask is like, how did you get into the blockchain? It's always an interesting story, and it was almost always someone mentions it or says this is a Bitcoin thing, and then someone starts to research, and the rabbit hole
it's
quickly
you can't get out.
Yeah,
you can't get out once you're in there.
Exactly.
So for me, once I started researching it, I really wanted to learn more. And started exploring it on the side, obviously investing personally.
Yeah.
If you don't have skin in the game, you're not going to really,
you're not in the game.
You're not going to understand it.
Yeah.
And, I founded an asset management firm actually with a few partners that had mentioned it to me before in 2013, because I went back to them and I said, hey, I want to learn about this space. Tell me a little about it.
Right.
And from there, I met Bobby, who we were first approaching as an investor in the asset management company. And the asset management company was based on what I knew best, which was research. And we were essentially doing a deep dive fundamental research on these protocols, saying, look, if we're going to make investments in this space, we need to understand these protocols from a fundamental basis, right? Understand what drives value in these networks. And we were essentially writing these research reports and then making investment decisions based off of that.
Oh, interesting.
And so we took that investment thesis over to Bobby and said, hey, would you be interested in investing in our fund and learning a bit more?
Yeah. It was early 2017. We're talking about how we got into the space. It's early 2017 that one of the families that we were working with came to us and said, hey, what's this Bitcoin thing? I'm hearing more about it.
One of the family offices came to you?
Yeah, I'm hearing more about it.
See, there's always somebody comes in, what is this thing? Or, hey, there's this thing.
And it's funny because I obviously heard of Bitcoin prior, but and Saad hates when I say this, but it was true. I wrote it off as something that, drug dealers and criminals.
The dark world.
Yes. Right? So, I mean, it's not a real asset. It's not real for something for us to focus on or dedicate time to. But in 2017, there was more and more inquiries coming into us, asset management firms and deals that were being shown to investors, high net worth investors that, they were asking us about. So decided to, do the research at that point and get more information on what the space was and how we could be involved. And that's when I kind of started down the rabbit hole. And through a mutual friend, I met Saad, as he said, as a potential investor in his fund.
Got it.
And did the due diligence, and for a lot of different reasons, we never invested in any crypto asset managers at that time. But the one thing that stood out was the research, in-depth research that his team was doing at the asset manager. So I said, if there's, let's continue this dialogue and relationship, because I want to learn more. Now I'm all in now. So if there's anything outside of, you guys are doing outside the asset manager stuff that is more business related or anything like that, let me know. And I'd love to chat with you about it. And it was in that vein that we started almost talking on a daily basis, going from not even knowing each other to talking multiple times every day about Bitcoin and the space. And it was more him educating me as a newbie, and then me educating him on the finance stuff, the aspect of cryptocurrency. Because it's the first time really you've had what are venture type investments, technology investments that are in a publicly listed vehicle,
asset. Right, exactly.
Right?
Yeah.
So all of the risks and things that you have to be cognizant of when you're dealing with traditional finance instruments that are publicly listed and easily tradable were now applicable to crypto world, but these weren't companies where you had revenue streams and profits and could come to a fundamental value to say, hey, this is worth in the worst case X, right? It doesn't exist in crypto, right?
Doesn't exist, yeah.
So it was a right off the bat, it was a great marriage of two separate minds that were kind of come together and collaborating on stuff. But what we quickly realized was that as more and more institutional investors were starting to look at the space, get involved in the space, thinking about making crypto allocations, they were going to need the same tools and products and services that they're accustomed to having. And so Saad simply asked me, he's like, what were you accustomed to having when you're trading on the desk in New York? And I said, well, obviously every trader has access to high quality research. We have access to high quality data analytics. We can run our own algorithms, create our own investment models, assess risk reward on the trades that we put on. And he goes, okay, that's interesting. I'm like, I'm sure that they're available in crypto land.
Right. You're like, yeah, of course that's available there, right? Yeah.
Like I think I even asked him, like, what websites can I go to get this information?
To get this information, yeah. Like,
and he said, there's nothing there, right? So, it quickly became apparent to us that there was a gap in the market. And the linchpin of it was that, crypto assets is now a real asset class that's going to be growing over the next X amount of years. And if that's going to happen, then institutional investors will come into the space, which we've seen in 2018. And when they do come into the space, they're going to want access to research and tools. And so that's when at the end of last year, early this year, we formed Node Blockchain, left our respective other firms, and we're a research and data firm now.
Got it. That's very, very cool. And so how many papers have you written in the firm now? How many of you guys published?
Yeah, so our initial papers were focused on more of a bottom-up approach. So assessing the individual assets, why they're valuable relative to others, and essentially...
So you'd pick a currency or an ICO of some kind and research the whole thing and basically build a case as to why you should invest or not invest, and how would you assess value of that?
Yeah, so I mean, a good example is, I think one of our first papers was on a currency called Decred, right? Decred is a hybrid consensus protocol, so it has proof of work and proof of stake, and I'm sure we'll get into that. Yeah. But essentially, we looked at that as an alternative to Bitcoin as a currency, right? And we assessed, okay, what makes this better than Bitcoin? What makes it worse? What are the positives? What are the risks? And essentially drawing down, through multiple variables that we would assess on things, fundamental drivers such as how many people are using this network, what's the hash power, what's the security level of this network. Right. So analyzing these different metrics that we determined drive value in these networks, and ultimately reaching a conclusion, similar to what you would see on Wall Street for an equity research report, right?
Like buy, hold, sell.
Buy, hold, sell. What's the risk level? Is it going to outperform or underperform what we believe to be the index, which is Bitcoin, right?
Got it.
And
that's an interesting perspective. I wouldn't have.
Yeah,
so it's all relative to that network because it's the biggest.
Exactly, that's the biggest and most powerful.
Most
network,
powerful,
right? Yeah. And so that's where we started, right? And we wrote, say, 5 or 6 different asset-specific protocol research reports. They did phenomenally well, of course, when everything was going up. But
because everybody needed something to make their investment.
But what was
hang their hat on,
more surprising for us is that they outperformed the top 50 index on the way down as well. Right, so Q1 we saw a huge drawdown in crypto, which was expected given
how high it had gone,
and I guess partially because of the timing of the reports,
right,
but also because the fundamental value relative to others, these assets are still alive, they're still thriving, and they're outperforming others that were relatively weaker from a fundamental perspective, right?
Yeah.
So we knew we had something right there with respect to how we were assessing the assets.
Got it.
And from there, we started writing these top-down reports as well, which is the one that you picked up, which is more of a thematic report to say, okay, now that we've done these individual asset reports, we need to start looking at wider themes in the crypto space to understand what's next in the blockchain world. And the first one we report was actually a really hotly debated topic in the Bitcoin world, which was on-chain versus off-chain scaling, which ultimately led to the Bitcoin Cash fork.
Got it.
Right, and we wrote that one to, again, same kind of viewpoint, a contrarian viewpoint. Everyone was writing about how off-chain scaling is better for Bitcoin. We said, let's take the other side.
Let's take the other side. The other side of the table. Interesting.
We kind of like that approach, and we did the same thing with the energy report, which is what we'll discuss today. But essentially, the motivation behind that was very similar. Mainstream media was focused on the negative, consequences of Bitcoin and crypto mining in general, and they would sensationalize it with these crazy headlines. Yeah, Bitcoin's using more energy than transatlantic airlines. Bitcoin's using more energy than electric vehicles around the world, and so on and so forth.
Because they have to put it in perspective so people will read the article.
Exactly. But you can make the energy usage look really large, which is what they were doing, but you can also make it look really small.
Interesting.
What we found was Bitcoin was using less energy than Christmas lights around the world, which we thought was,
that's a good,
funny spin on that.
Spin,
Yeah.
So exactly. I thought, wow, they use that much energy. I was amazed by that.
Yeah. So that's kind of what motivated that specific report, and
cool.
Just from there, we decided to give the world an opposing viewpoint and found some interesting results.
Right.
And that's what struck us. We saw the paper. I mean, we've been taking this view as Soluna. We're going to build this vertically integrated company to power the blockchain, and forming any company, you need to have a belief system, a basis for why you're doing this. Why do we exist? And we exist because there's this big energy problem that we think we can solve, both for the blockchain ecosystem, but also for the world. The world needs more green power, and the blockchain ecosystem needs more power, right? And it also needs more green power, and if we can build the power, we can do that. But you also have to believe that there's something about the ecosystem that implies that this is an eventuality. Like at some point, someone eventually has to do this. And when we picked up the paper, what we saw was that someone actually made the case, you call it top down, but I'm saying from the ground up, like starting with how the ecosystem works and then sort of building it from there. What I wanted to ask you guys, and why I wanted to sort of get with you, like, how did you decide what was your approach to going out and doing the research? Like, you stole the thunder for my question around, like, how'd you come up with this paper, and, why'd you call it the positive versus negative, which we get, but then, like, how'd you approach the research? So you're going to take the other side. Where did you start?
I think the place that we started, and you'll notice this as a theme throughout the paper as well, is we took an economics approach to this, right? And that's evident by the title as well, the positive externalities of Bitcoin mining. And that's what really drove a lot of what we were doing in the report. We took a step back and said, look, this is a $5 billion, just for Bitcoin alone, a year industry with respect to revenue. What's driving this? What's driving this incentive? What's driving all these different competitors and players to invest all this capital into this space and they're extremely profitable.
Right.
There has to be something
top of
behind
that,
this, right? There has to be something behind this, right?
Interesting.
And what's interesting for us is that, look, it started off as just a white paper, right? And it grew into what it is today. So there has to be something behind that. And what we found was that the main driver behind all of this was that core principle behind proof of work mining, which is this economic incentive system for competitors to compete and participate in this market.
Right.
And while they're competing against one another, they're actually helping the network significantly.
Right.
So that's what kind of drove our research. And from that, we said,
so it's
look,
a network effect with like a embedded economic incentive to participate in that network effect. It's very, very brilliant.
Yeah, and our initial thesis was just, look, our thesis is that this is the world's first global mechanism to economically incentivize the efficient usage of energy. That's what we started with.
Wow.
And we just kind of dug deeper from there.
And I think
Wow.
I think
cool.
the paper in general and Saad and our research team's approach to everything that we publish kind of is colored by my background as an investor.
Right.
Because if you want to read the paper, it's not an academic paper.
It is not an academic paper at all.
None of the research reports that we write are academic papers.
Right.
They're all through the lens of there has to be some conclusions drawn. And economic conclusions that will lead to
really run it from it's an investor's lens.
Yeah, exactly. And I think that's what has gained traction, not only from the protocol level research that we do, but these big thematic pieces, because there's no shortage of brilliant minds in the blockchain space and the cryptography space that are approaching topics from an academic view.
Right.
That's not who we are. That's not our background.
Right.
We're looking at things not strictly, but from a different perspective.
Right.
And bringing that economic and investor perspective to it, which we think will add value, because ultimately our goal with all of this research that we're putting out is to attract investors to the space and grow the ecosystem.
That's right.
And make it more legitimate. So, cool. Our thought was that with the research that we do, if we're going to approach it from an academic point of view, we're adding very little value. If our ultimate goal is to grow this industry and be a participant in a growing industry and bring more people to the space, then we have to talk their language.
Yeah, that makes sense.
Right? Yeah.
Like if you look at it as, any financial research, right, they start by educating the investor on what is this new industry, what problem does it solve, and then how does it make money? And how can an investor make money by investing in this industry? And that paper has a lot more value to an investor. What's fascinating is, so when we found the paper, I read it and I was like, I sent it to the whole team. You all have to read this. This is like, we could have written this and it's just unbelievable. And the general partner of Brookstone, our PE firm, he read it and he said, this is unbelievable. And I think the reason he thought it was unbelievable is because just about every piece of content he's read before has been research oriented, and he's more of an economist, and it was just brilliantly laid out from that perspective. So why don't you guys walk us through a little bit sort of how you make the case? You do it in a few ways, sort of very methodically, starting with, as you said, proof of work and this whole concept of the economic incentive created by Satoshi's design, and then you start with chips. Walk us through that. Like, what about chips, and what's interesting about that?
Yeah, I think let's start with the proof of work piece.
Okay.
Just at a high level.
Yeah.
Because I think that's really important to understand.
Mm-hmm.
And it's important to understand because the majority of coverage on proof of work hasn't been the best, right? And let me explain that. So most people that criticize Bitcoin's proof of work always look at it from a per transaction basis. So they'll say Bitcoin is using this much energy per transaction.
Right.
And every time you think of that number, it's going to be really large.
Of
and
course.
it's only going to grow.
It's
only going to grow.
Yeah.
Right. And that's a fundamental misunderstanding of how proof of work actually works.
If you're writing an article from the other side saying this thing is really bad,
that's what you want to say.
Energy per transaction is the right way to do it. But what you're saying is technically that's not the right way to evaluate it. Right.
Yeah. And the right way to look at it is Look, if you really understand proof of work, the fundamental utility of proof of work is to secure an economic history.
Right.
Not just the transaction that's going through the ledger at that specific time, but the entire history of that ledger. And the way Bitcoin works, of course, is that history is unchangeable forever.
Right.
So every time a new block is added to this chain, Bitcoin's history, the more secure the previous block is, and the one before it, and the one before it. So every time energy is expended in proof of work, it's not only securing the transactions that are happening at that point in time,
I see.
but every single transaction that ever happened
I see.
on Bitcoin. So when you look at it from that perspective,
it all builds on each other. So the every block that's added is protecting
correct.
all the previous blocks that have ever been added to the network.
Exactly.
Got it.
Because if you were a malicious actor and you wanted to change something on the blockchain, not only do you have to change that specific block that the transaction is in, but every block after it. Right. And that process is nonstop. Every 10 minutes, there's a new block being added.
Right.
So
now, is it every block after it or every block before that's existed before it? Because when I read the paper, that was a question I had. And it says, well, isn't it the previous set that you're protecting?
So let's say you want to change block N, right? And you want to change it because there was a transaction in there. You transacted 100,000 with someone and you want that back. Right. That would be your incentive. Yeah. To change block N, you would have to change block N plus block N plus 1, 2, 3, 4, 5. Every other block that was added after it. Got it. And catch up with the existing miners on the chain. Right. To do that, it's first of all, it's extremely expensive. Right. And it takes a lot of computing power, a lot of electricity. And guess what? You're better off just using your resources to mine them because you'll make a lot more money. Right. So, you know, the whole
Could you put that in perspective? So what would it cost to attack and...
Yeah, I think based on the computing resources used today on the network, it would be somewhere in the $4 to $5 billion range, billions. Just from a hardware perspective. Amazing. Capital cost.
Amazing.
And then that's
to attack the network and basically rewrite it, essentially.
Exactly, because to attack the network, you need more than half of the computing resources on the network today, which today is incredible. Yeah. I don't think there's a more powerful network of computers in the world.
Exists today. Exactly.
In the history of humankind.
That's right.
Right. So to attack the network, you need all these capital resources and you need to be expending electricity
to power them.
So
that $4 to $5 billion was just to buy the computing power you would need to attack it, and then you'd have to expend energy to power that. So that's probably a few $1 billion on top of that, like whatever that is, or however long it would take you to attack it, right?
So if you're looking at this, you're saying, is it in my best interest to attack this network, or is it in my best interest to actually work with the network and earn those rewards? And that's what keeps this all together. Right? There's no central party telling anyone to, mine Bitcoin.
That's right. That's the amazing thing about it. Yeah.
Because it's in their best incentive.
Exactly.
Economic incentive.
That's what it comes down to. Yeah.
Got it. Yeah. So that's the first step. Then you sort of transition to, because of this economic incentive, it creates this competition among the members of the network to win the blocks. Exactly. And competition breeds, all sorts of types of innovation, right? Yep. And the first one seems to start on the chip side. And you want to walk us through that, or Bobby?
Go ahead.
Yeah. So I mean, just on that point. So just to wrap up the last point there, because of that factor that we're securing an economic history, Bitcoin is actually improving in efficiency over time. Yeah. It's improving in efficiency over time because the efficiency of the hardware and energy used is actually declining, and the value that it's protecting is increasing faster.
And why is the efficiency decrease automatically true? Is that because...
No, so that's not automatically true.
It just happens to be true.
It happens because of this, as you mentioned, this competitive nature amongst miners.
And so what you guys noticed was that when you looked at that, the results of that competitive nature, you notice an increase in efficiency, correct, right? A decrease in energy use as a result. Yeah.
Increase in energy.
I mean, increase in efficiency, correct, is what I meant to say. Yes.
Yeah. And the simple fact is, from an economics perspective, the mining industry is highly competitive. Highly competitive. There are very few barriers to entry. to choose between suppliers, so to say miners, you're indifferent because they provide the same exact service. And there's extreme rivalry amongst miners because they're all fighting for the same reward.
Right.
Fighting, I say, but competing for
competing.
the same, for the same reward. And the chance to get that reward actually declines as more entrants, come into the space. Yeah. So that results in a highly competitive industry. And of course, in a highly competitive industry, if you're not innovating on cost, which is the primary driver of profit in the space, you're going to get left behind really quickly. So in the early stages, and we kind of divided mining into two stages. The first one was primarily focused on innovating the hardware used in mining. Right? So, in the beginning, mining was done with CPUs. Right. So anyone in their basement could
download the
Bitcoin software, run it on their laptop or home desktop, and start mining. Yeah. Which was great back then, by the way, because you were getting 50 Bitcoins every 10 minutes.
Did you guys read that book, Bitcoin Gold? And I was reading that, and no. It's called Bitcoin Gold, I think, or something like that. And it's a great sort of history around, starting with the paper all the way through, and it kind of covers how Finney getting this email from this guy, and he's like, well, let me download this thing, and he's just like, he ran the mining module, and all of a sudden things, Bitcoin is, his machine blows up. That's kind of where it started, right?
That's where it started. It started in basements, essentially. Right?
Really basic
early
hobbyists.
adopters.
Early adopters. Geeks, guys into the whole, digital.
And then
cash.
from there, obviously competition breeds innovation. So a few miners realized that they could mine more efficiently using GPUs. Right. So they switched to GPUs. Obviously, GPUs cost more. Then a few miners realized they could mine even more efficiently by using FPGAs, which were more specific specialized chips. Yep. And then industrial miners, the biggest obviously being Bitmain, realized that they could build special purpose chips specifically focused on mining Bitcoin. And that is essentially where everything changed, right? So now you have these industrial players coming into the space, realizing that, hey, this is a huge industry, right? We can build hardware that mines way more efficiently than anyone else. Let's build our hardware, let's sell it, and let's use it in our own operation as well. So they were vertically integrated from a hardware perspective. Yeah. And the best miners in this space, at least until today, because the biggest cost was the hardware and how fast it was depreciating because of the innovation in the space, had to be hardware producers.
Got it.
So Bitfury, Bitmain, all the big names in the industry today, they had the best margins. Why? Because they were innovating and producing their own hardware, and obviously using it themselves first, right? And then selling it off to the general public.
You mean they were testing? So they were testing the machine.
Testing the machine.
Yeah. It's now beautifully called pre-mining.
Yeah, exactly.
There's a name for it now. It's amazing.
Yeah. So you had these guys, innovating on hardware at breakneck speeds. Right. Obviously, because they're competing one against another, and the industry is worth a lot of. The reward is huge. Right.
So the economics allows them to even fund that level of innovation. Right. Yeah. That's the beauty of it. Yeah, exactly. So they're making money, so they can they're making innovate.
Huge money, and they're basically getting these pre-orders on these machines that they can use to
that
fund
they can
their
use.
R&D.
And they're getting it at cost. Yeah, exactly. So
it's incredible, and what that resulted in, and because the innovation from a chip perspective, not only had the chips had to be more powerful, they had to be way more efficient. So there's a metric that we actually track in the report as well, which is joules per gigahash. So how much energy is this chip using per hash that it provides you to mine on the Bitcoin blockchain? And what we saw as a trend with respect to mining hardware was, look, this is beating Moore's law. This is beating these computing laws that have been written and been around for years and years and years and years. And the simple reason it comes back to the economic incentive, because there's a direct incentive to create more efficient computing hardware. And we never really had that before in computing technology before. I mean, the closest thing you can get is there was an indirect incentive to create more efficient chips so that they could be used in more portable devices such as cell phones, laptops. But obviously things like that kind of taper down over time. Whereas in this case, there's a direct incentive, and it's extremely powerful. Right. So that's what drove a lot of these, hardware producers to innovate at breakneck paces. But of course, like every other, computing innovation in the world, it's got to trend back to the mean.
Right. Because everyone else gets the idea. That's a good idea.
Yeah.
And starts doing that. Now, the guys, like the Bitmains of the world, the Bitfuries of the world, I'm not totally locked in on history, but in your research, did you find that they were miners at first and they said, what if we built our own chip? Is that sort of the light bulb that went off, or were they always in the chip space and then they decided to sort of like look at this mining things that they seem to be making money? And
yeah, a lot of them actually started off as miners.
Right.
And they saw that, look, we have this background in building computer chips.
Right.
Let's just build our
Let's
own.
just build our own chips.
More efficient. Right?
Yeah, that makes sense.
And it kind of just grew from there.
So where did the rabbit hole take you from there in the research? So you went from chips to...
Yeah. So obviously on the chip side, what we quickly realized was, look, this innovation is great, but right now it's being used solely on Bitcoin mining. So it only has one specific purpose. But what a lot of these hardware producers realized, and they're starting to kind of market it a bit more now, is that they can use the innovations, the teams that they have, obviously the capital that they've raised as companies, and start using these designs for other applications as well.
Other
So,
high density applications.
Exactly. So anywhere else where you need high computing resources, such as machine learning, which is one of the earlier applications, you can take what they've done there and apply it in that situation as well. So we're seeing that starting to come alive in the industry a bit more. And obviously for these guys now, for example, Bitmain's going public, right? So as a public company, there's going to be a lot more scrutiny on what they do, and they don't want to be reliant on one source of revenue. So they're diversifying.
So they got to show diversification, they got to show growth potential. And the next frontier for applying, because every company becomes really good at something, and they're good at, applying specialized computing to this mining business, but they're also really good at developing specialized computing.
Exactly.
And there's another industry that could use specialized computing, and AI and machine learning is an opportunity for them.
And I think it's also a function of just the market, right? They're very cognizant of the fact that there's more competitors entering the space.
Right. What can they do? It's going to become very crowded.
Exactly. They've had the luxury of being one of 3 or 4, a handful of players. But now the simple fact that they've disclosed all the financial information in their IPO filing,
that's going to change the whole.
Probably open up a lot of eyes at some traditional companies that are like, hey, this might be a space that we want to get into. Right. And so I think just natural survival mechanisms, they're looking at
diversifying. Makes sense.
And look, there's no shortage of demand for compute power. As the world is getting more and more data intensive.
That's only going one way. That's the bull market. That's a real bull market. Right?
Absolutely. Whole concept of data is the new oil, and there's all sorts of terms around it. But it's true that we're basically becoming a world that lives and breathes on this ocean of data that powers just about everything, right? And we want to have it right at our fingertips, and it can be leveraged to automate and do all sorts of amazing things.
And the big problem is that we can't turn back now.
Oh yeah, there's only one direction.
And then you can't even pull back, right? So it's only going to grow exponentially as more applications and technology increases and come to market. So I think that's the one thing about the crypto industry and the mining industry specifically, is it's just opened up a lot of people's eyes as to what computing power can actually be used for. Right.
There's something you do in the paper also that I find very interesting, and that is that you, again, you're taking the other side of the table, of course, but in the paper you also really zoom in on this concept that the energy expenditure of the Bitcoin network is a wasted activity, and you say, well, let's take a closer look at it. Is it really a wasted activity? And one perspective you take is, well, that energy is being used to secure a network, secure a history of value, a history of transactions, right? And the other perspective you take is to say, well, let's look at how you actually determine whether something is wasteful or not. You want to elaborate on that?
Yeah, I mean,
that was interesting how you said, well, wait, well, how do you define wasteful?
What's interesting though, before Saad jumps into it, is when we were in the process of coming up with the idea, and Saad was, we were just sitting at the desk one day and thinking about, okay, what's going to be the next thought piece that we come out with? And he's like, I really think, you know, a lot of people have been focusing on the energy side of things, but I think there's a different story to tell. And we sit beside each other. I'm like, what's the other side of the story? I mean, it's pretty plain and simple. But he's like, no, well, look at some of these stats. And he starts, and he'll probably highlight a few of them, but starts firing off these stats. I'm like, oh, well, I didn't even know that. That's crazy. Well, that makes sense. Let's dig into this.
Right.
And so I think we did take the other side of the table on that.
Yeah.
But it's what the numbers showed us. It's
Right.
what the research showed us. It's what the data showed us that, you know, we've only been told one side of the story in the news
Right.
and mainstream media. But if you actually take a step back and look at it at a very high level and look at things from, you know, top down, there's a different narrative here that needs to be told.
Mm-hmm.
And, you know, I just let you tell. So I, at the end of the day, I was surprised too,
Yeah,
right? Because
yeah.
I was hardly
You're like, what
in
are
the other
side?
camp.
Like,
I'm like,
how could you take another side on this?
Yeah.
There's no
like
other side. There's no,
like the numbers are the numbers, dude, right? So, yeah.
And I think just speaking on that point with respect to is it a wasted energy or not? I mean, ultimately, what is waste, right? From an economics perspective, there's someone paying for this energy usage.
That's right.
It's the holders of Bitcoin. It's the
Right.
users of Bitcoin. Ultimately, they're subsidizing the revenue of the miners.
Right.
So there's a demand for this energy. And guess what? The marginal utility, what the market is telling us and what the numbers are telling us is that the marginal utility of 1 watt of energy burned in proof of work in some parts of the world has a higher marginal benefit than the marginal benefit of that watt of energy being used on the grid.
Wow.
Because that's what the miners are paying for.
That's exactly what they're paying for.
That's what they're paying
Interesting.
for.
So it's the best, the best economic use of that power.
Exactly. Exactly. And that
Interesting.
that simple concept actually drove a bigger point in our paper as well, and helped us research a bigger point, which is, you know, why is that the case in some parts of the world? Why is that the case? 1 watt of energy or 1 watt of electricity generated in Canada has the same utility as 1 watt of electricity generated in Morocco or India or anywhere in the world.
Right.
It's a homogeneous good, right? There's no reason why.
Power is power. Yeah.
Power is power. It should be priced the same throughout the world.
Right.
From economics perspective, it has the same utility.
Right.
Why is that the case? Well, it's because of the way, you know, energy is basically sourced and distributed throughout the grid, and because the energy market actually isn't that efficient. If you really look at it from a global perspective.
Right. There isn't like a global grid where energy can get anywhere. To some extent, it's locked in a particular geography, right?
Yeah, and it's interesting for us because in Canada, we're actually net exporters of electricity. Right. We produce a lot more than we actually use, and
probably New York's fault.
And lucky enough,
city that never sleeps. You know,
we have friendly neighbors down south that we can sell this electricity to.
We're more than willing to buy it. Yes, we need it.
Yeah, and that's just the case of you know, any other commodity market in the world. There's a market that determines the price of that commodity throughout the world, and that's what kind of drives efficiency in the price of that commodity, because it's the same utility. A coffee bean is a coffee bean wherever it is in the world. Yeah, and the same should be true for electricity, but a mechanism hadn't been created to kind of facilitate that. So then we had another hypothesis. We said, what if Bitcoin mining becomes the ultimate energy arbitrage throughout the world? So that one was a bit crazy in the beginning. I said it out loud to Bobby, and he looked at me a little bit weird. He said,
"He's like, okay, now what are you smoking now?
what are you on about? How is that ever?
Or a new
work?
diet or something?"
But basically, what stemmed that idea was, you know, I'll give you an analogy here. Let's say, you know, the world we took a 3D topographic map of the world, right, where you have really cheap energy, you have these valleys, and it's a blue area, and you have these really expensive areas of energy, higher areas, it's red, right? So you kind of get this vision of the world now where some areas are cheap, some are not. Bitcoin mining is like pouring a glass of water over this map, and it's just going to smooth all the nooks and crannies, right? And how it's going to do that is all the miners, because they don't care where they mine. It doesn't
Right.
matter to them. They're agnostic.
Yeah, many of them are nomadic, so they
Yeah.
can move around and
Exactly. So
Get
they
to the
can
right
move out
place.
to wherever it's cheapest.
and you can join the Bitcoin network anywhere in the world.
Exactly. So they're going to go to areas of where the energy sources are cheapest
Right,
and start utilizing that, and move out of areas where electricity is more expensive.
right.
And that's essentially going to smooth out the price of electricity throughout the world,
Interesting.
creating what we think to be the ultimate arbitrage of energy prices.
Interesting.
Yeah.
Wow. Guys, this has been really fantastic.
Appreciate
Thanks for taking the time. Well, we'll see you guys soon on our next podcast. Thanks for joining us. See you soon.